Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. We define insights as concepts that are counterintuitive, widely misunderstood, or underappreciated. In other words, unique ideas that you probably won't hear elsewhere. I'm Alex Shahidi, the host of the podcast and co-CIO of Evoke Advisors, one of the nation's leading investment advisory firms. Learn more about our show at insightfulinvestor.org. Today's guest is Bob Chagares. Bob is the founder and chairman of High Street, which is a private real estate manager that invests in industrial and logistics properties. High Street has invested over $5 billion since its founding in 2002. Bob, thank you for joining me today.
Thank you, Alex. Nice to be here.
Let's go back a few years. You started in the business almost 40 years ago. What would you say sparked your interest originally in commercial real estate?
I always had this interest, even as a little kid, in architecture and building. I did a lot of geometric drawing all the time for whatever reason. Ultimately, I went to law school, became a lawyer, and was practicing for just a couple years. And I knew almost instantaneously that I'd be happier being involved in real estate in some form or fashion and probably being a developer to build something, and kind of figured out that what I was doing would probably never produce any tangible assets in law, but just kind of a winner-loss in an endless zero-sum game. So at that time, I had moved to DC, where one of my fraternity brothers had gone to work for a large commercial brokerage firm. And then another friend of mine had been working commercial brokerage in Chicago and moved to Houston as a commercial real estate broker. And I talked to those guys and I asked them to introduce me to other brokers and especially any developers that they might have relationships with. And all of those conversations made me more intensely interested in the industry, less interested in being a broker and more interested in being a principal. And coincidentally, the Houston office partner for Trammell Crow Company that my friend was close to in Houston was asked to move to DC to take over the DC office for Trammell Crow. And he said, I'm going to introduce you guys, and I know you both, and I know you will become partners and best friends. And that actually happened to this day. My old partner is retired from Crow, but we are as close as we can be this day. And actually, the three of us are, including the friend of ours that introduced us. So that was sort of my introduction and my thought, sparking my interest in commercial real estate.
So you talked about the ability to build something that will last a long time. So besides that, is there something about real estate that has kept you in that industry for almost 4 decades and something about it that has allowed you to devote your career to it?
I think during the interview process, sometimes you stumble onto things where you feel like your skill sets, things that you're kind of naturally predisposed to, fit. Real estate is, interestingly, very much a people business, and it's whether it's internal or external, especially if you're a developer, because you have to deal with literally all kinds of people in all kinds of ways, from government to other professionals, third parties. But I think during the interview process with Trammell Crow, it all kind of came together. Every person I met in Trammell Crow in the DC region, and then they send you on to meet the national partner in Houston and then the senior most partners in Dallas, just made me want to be part of Trammell Crow Company, especially, but really in commercial real estate, and sort of describing this path that every new person to Trammell Crow that would be on a partner path would take, which was from a leasing agent, where you literally were expected to go out and cold call tenants and fill the buildings in the region you were working for, to a development partner. Those skill sets that were needed, and really, again, the opportunity to build something tangible and potentially make money at the same time, I felt like all those things either described what I could do or what I wanted to do. And then it was interesting, in my first few months at Trammell Crow, and literally not knowing any better, I was asked to lease this remaining space in one of the buildings that I was responsible for. And it literally was landlocked. The way it was set up, it just didn't work very well. And so I went to 3 of the tenants and just said, can I get you to move here, and for you to move here, and for you to move over here, and then I can free up this piece of space. And incredibly, they all agreed. Now, there were some costs associated with it, but when I took that back to the partner who had hired me and explained what I wanted to do, he kind of looked at me and go, well, we've been staring at that piece of space for quite a while. He goes, great idea. But it was just that, getting something done that was a challenge. It's not that it was overly complex, but it was a challenge. It was there and got to figure it out. And ultimately, when I had joined Trammell Crow, most of everybody there was an MBA of some sort. I had the law degree, so I felt like the cat in a room full of dogs. And I said to my partner at one point, I said, you got all these MBAs running around. She hired me. And they said, well, I can teach you everything they know, but I can't teach them the things that I think you know, having spent the time in law school to write, read, speak contracts, put business terms into words, things like that. And I didn't really believe him, but he was good on his word to make sure I came up the curve on all the finance stuff. And the rest of it was just great. So I literally knew when I joined Trammell Crow Company that in the industry, it was a lot like meeting my wife. I knew I was where I belonged.
Love at first sight.
Yep, absolutely.
Well, you spent 17 years at Trammell Crow, obviously a very highly respected organization. What were the key lessons that you learned while you were there that are still with you today?
Three main lessons that absolutely drive everything that I do and I've done. One was how to underwrite and assess risk. My senior partner taught me that, and I love this metaphor, it was the bullet that can kill any leasing or development deal is already in the air. You need to carefully structure every deal to prevent that bullet from destroying your opportunity. And that intense focus came with me to High Street. And I believe that kind of risk on always approach really does continue to govern our investments today. Two, and along those same lines, you want to invest or develop assets that will lease in a down market. And that was one of the most valuable lessons, that an asset that will subdivide into small spaces in a declining economy will lease, because declining economies inevitably drive down tenant size. And if you want to continue to generate revenue in that asset, you have to continue leasing. So if you have a building that's just binary and is either leased as a single tenant asset or it's empty, that property will be forever at risk. And I'm really talking about assets that are sort of generally plus 100,000 square feet. But as recently as a few months ago, we had a building that we'd looked at once before, came back around again. And again, it was the binary nature of that building that just scared me to death. Just didn't have any flexibility. So that was probably number two. And three, and I think this may be the most important at a level, was just the importance of being a good steward. I believe that stewardship is the most fundamental component in leadership and really critical if you're going to drive a team or manage capital that doesn't belong to you. It obviates self-focus and allows you to be riveted on success while serving the needs of your partners, their capital, and your teammates. And as part of that, just the concept of, and this was a Trammell Crow thing, of diluting to make new partners. That mindset has benefited my ability to step down as CEO and transition to a new generation. And we'll talk about it in a minute, but adding a new partner where you create a disproportionate increase in the sum of the parts and a willingness to do that over and over again. And I think that's a key part of that stewardship piece.
You said something there that I think is really insightful and something that I've heard on many of these podcasts that I've done with people who have been in their industry for a long time and have survived the downturns. And that's this notion of thinking about the next downturn, trying to position yourself to protect against catastrophic loss during that downturn. And it's so easy to forget about that when times are good. And I've learned that the people who've been in this industry for a long time have that mindset all the time. And what you described is very similar to that.
Yeah, very much.
So you left Trammell Crow in 2002 to start High Street. What were you thinking at the time in terms of it's time for me to start my own thing? Why did you decide to do that? And also, why did you decide to focus on industrial and logistics at that time?
That was a very emotionally difficult decision because I love Trammell Crow Company. I still love the Trammell Crow Company. It still exists. It's a subsidiary of CBRE. Some of the same people I was partners with back in the day are still involved. But it was a difficult decision. So I joined in 1985. But by 2002, and this was 5 years after we went public, the global services component of Trammell Crow Company became kind of the key driver in the company's stock price, since those revenues were viewed as largely recurring versus development fee revenues that the street just had a hard time ascribing a multiple to. couldn't figure it out. And we were always a little weird because we were a services company and we weren't a REIT. So we also had that going for us at a level, good and bad. So after the IPO in 1997, Crow targeted primarily facilities management opportunities with the IPO proceeds, and a number of those contracts pursued by our corporate services group involved companies and universities in my Northeast region. That meant that we were suddenly responsible for a lot of third-party employees that flowed over to the operating and management of our side of the business. So at that time, myself, as well as two of the other three founding partners of High Street, were managing hundreds of people by virtue of being the regional and super regional partners for all development, investment, and global services in the Northeast. And as a result, we just became further and further removed from the real estate and the deal business day to day. I used to joke, I felt like a glorified day camp commander, just fielding issues, a lot of human resources stuff that came down the pike. So we started High Street to kind of get back to our roots as deal guys, with the idea of forming a scalable niche, vertically integrated investment management company and a platform where we could touch the real estate every day. And equally important that even as we grew, we'd never get too far removed from the deal making. But in many ways, the Trammell Crow Company influence in each of us as leaders of a new business never left us. I said that earlier, but I'll say it again here. With one of the ways in particular shaping where I am today, having transitioned from CEO to chairman last June, and that's that we recognized and valued Trammell Crow Company as the ultimate evergreen company. We had survived Trammell. He had largely been moving on at that point. And we saw the opportunity to do that at High Street, which was another draw, if you will, in setting up this company. And it was almost organically driven by the fact that among our founding group, we had an age range of 22 years. And I was the youngest at 45. So that was either going to happen or we were going to have a wind down and be done. So here we are 22 years later. All the other, my founding partners and good friends have retired over time. And my succession as the last remaining founder is now fully locked in. And the company is now being run by the next generation, all with an incredibly bright and even brighter future with great odds that another 22 years are in the offing. So I'm extremely proud of that and excited for High Street in the long run. And then for the second part of your question, the decision to pursue industrial and logistics, we had all been involved in all the asset classes, which was fairly typical, although I'd say slightly less on, say, retail. None of us have been out doing retail shopping. We did a lot of retail that was attendant to office services, if you will, especially in the urban markets. But the decision to pursue industrial exclusively was unanimous for a few reasons. One, just our perceived and, in fact, low barriers to entry. And that's largely because there's fragmented ownership across the sector. Even in our target markets, which are major markets, which are made up of about 8.5 to 9 billion square feet of total inventory, 52% of it's user-owned. And the balance is owned by just literally hundreds of different groups, individuals, with only about 11% controlled by the largest institutional owners of industrial real estate across the country. So there's that fragmented ownership and low barriers to entry. The other thing was just the low volatility associated with the asset class. And from where we wanted to start, the ability to start with an investment product that could function like a levered fixed income vehicle with some upside or core plus. As one of my founding partners would say, we're going to invest in core with attitude. And then with the idea of eventually moving into value add products, including ground up development over time.
Would you talk about how your vision for the business has evolved since you started it 20 plus years ago?
Yeah, I like that question because between 2002 and 2008 and up to the beginning of the GFC, our focus was on investing in industrial assets across both major and secondary markets without particular focus on the size of our deals, although most of our deals were smaller boxes, with some investment in what we'll call flex and higher finished shallow bay assets. And these could also function as single-story office. And back in those days, there was a place for that because suburban office would heat up. These were typically much less expensive. They had some warehouse space in the back. It's funny, you'd see owners that would go into these buildings would use the loading, but in addition to that, might have their boat parked somewhere in that back of that warehouse. So it was just kind of an interesting product. but it was institutionally owned widely, but we probably did about 20% of that. And then I'd say that going into 2009 with the GFC now in full swing and months after Lehman's collapse, we did a thorough internal look back, lessons learned from our first 6 years on our investments before the GFC. And we recognized instantly what was working well and what didn't. And we saw very clearly the differences between and the benefits of investing in the smaller buildings versus the bigger box assets, investing in major versus secondary markets, investing only in low finish, and that's the office finish. So office could be typically 6-7% of one of our buildings today, and that's where we like that number to be. The higher the office finish, the more capital associated with rollover. But we could see that an obvious and considerable capital drag and impact on cash on the properties that were higher finished. And then on the plus side, this inefficiency inherent in sourcing small box assets where we can create upside on the buy. And that's been a significant component of what we've been able to do over the years. So in mid-2009, we narrowed our investment strategy and refined it to exclusively invest in small box assets in infill locations in major markets only, and only in warehouse and distribution buildings that had low office finish. Again, sub 10%. No investments in higher office finish, light industrial or flex product. And we've adhered to that investment strategy, which for the last 15 years has been highly defined, cycle tested, and really characterized by consistency, which I think has been a big plus for us in terms of attracting new investors. And our focus on these properties, sort of why, again, so go to the next level, why these assets. And again, it's really based on the low volatility characteristics of infill industrial. And that's one of the reasons why it's historic and attractive absorption ratios associated with small box assets. And that's really less than 300,000 square feet versus big box over 300,000 square feet. The portfolio support that we think we get that's associated with intrinsic value of infill land, that's a constant. Our perception of risk relative to a smaller diversified tenant base, our average tenant size is about 50 to 60,000 square feet. Historically higher yields associated with infill distribution assets, and then really the competitive barriers associated with building a large portfolio of industrial small box assets. It's a lot of work. You've heard this before. A small deal takes as much time as a big deal. But also if you're an investor with a very large fund, our average equity check over 22 years is $6.2 million. That's probably not where you can afford to spend your time or just to be able to put the money out in the volume you need to if you're raising $1 billion, $2 billion funds. That change of vision and why, our investment strategy, so over the last 15 years has been ironclad, but really, again, focused on these small box, regional infill, major market properties that are located to the customers that are serviced by the tenants in these properties. For a long time, we just called these local and regional distribution buildings. The last mile tag wasn't associated with any of this at that time. And then finally, in terms of vision, as I mentioned above, we had always intended to launch a proprietary value product, including ground up development. And all of us were developers in our prior lives. And we knew we wanted to evolve over time towards a value add and eventually opportunistic by having development as part of our investment offering, and had a plan to build out a fully integrated development and construction team. Because having a captive team rather than relying on third parties was something that we knew the value in that, and we've done that.
I'd like to zoom in a little bit on logistics because that's kind of a booming area. And to start, it would be helpful if you could just describe the difference between industrial real estate and logistics so our listeners are all on the same page as we dig into this a little bit more.
We just had our annual meeting. We had a few of the senior folks from CBRE come in who are people we know well and we've done a lot of business with. And just to talk a little bit about the market at the front end, I think it's always interesting for our investors to have third parties to listen to. But if you put each one of those guys in a room and then put each one of us in a room and ask the same question, I think you'd get as many different answers as you'd have people lined up. Very simply, I would characterize industrial real estate as being comprised of warehouses, which include warehouses where light assembly takes place. Products brought in, it's put together, and then shipped out. Manufacturing plants or even heavier types of processes like injection molding, things like that. Those are industrial buildings the way I see them. Logistics real estate I characterize as comprised of pure distribution centers, either to other distribution centers or third-party businesses or direct to consumer. Also transload facilities like truck terminals, on or off tarmac, air freight distribution, and last mile delivery stations that we see now, and all of which support supply chain operations.
Logistics have evolved considerably in a relatively short period of time. You've obviously been following this market for a long period. Would you share your perspectives about its history, kind of catch us up to how it's changed through time?
We could go way back. Logistics was the province of armies forever and ever. But I think just to kind of bring it to a starting point, I think the most significant part of the evolution of logistics over time, and really the game changer, has been the digitalization of logistics and supply chain management, all driven by the internet and technology and ultimately e-commerce. So over the last 12 years or so, while the U.S. industrial sector's fundamentals and long-term trends still reflect these sort of significant and structural demand drivers like U.S. manufacturing growth, population growth, the most significant driver has been the growth of e-commerce and omni-channel distribution. And that's happened because e-commerce has driven critical changes in consumption, consumer buying habits, which has resulted in, again, the reconfiguration of global and corporate supply chains. And from about 2012, e-commerce very simply and very rapidly started this dramatic transition from expensive bricks and sticks retail model to the comparatively inexpensive bricks to clicks distribution model. And that transition continues today. And over that time, we moved from the very first phase of e-commerce distribution, satisfied initially by these millions plus square feet fulfillment centers, or what we called first mile, and then just sort of evolved rapidly over this period of time to anything in between 600,000 feet, 800,000 square feet, where air freight would come in to get sorted, and then ultimately to the other end of the barbell to last mile distribution. And that really happened as consumer demand became more and more apparent for expedited delivery and caused supply chain changes to respond. My partner says this all the time. He goes, I never knew I needed something in a day or less, but now I do. And I think we've all come to expect that. And then what we saw in that time period is e-commerce growth as a percentage of non-auto retail sales started this incredible march, growing 15% a year from 2012 to 2020, and then COVID hit. So within weeks of the pandemic, and this may be the most significant thing to occur just to spark the growth in logistics than almost any other factor, but COVID just significantly accelerated everything, enhanced permanently long-term industrial and logistics demand in several ways. One, it accelerated the adoption of e-commerce and online shopping by people in the U.S. that have been either refused to do it or have been slow to adopt it prior to the pandemic. And then within weeks, were forced to go online. And that also included a dramatic increase in online grocery and food demand, which is significant. Number two, it changed supply chain management to include higher business inventories and safety stock. And that was in response to this immediate collapse of supply chains that was occurring at the time. Number three, it accelerated the build out of that kind of hub and spoke model, and then ultimately pushing more small distribution centers out. Next, it caused this sort of Eastern migration of port of entry TEUs, which for years and years, freight flows that came in terms of container traffic came into the West Coast, about 60%, and the balance, 40%, came into the Gulf and the East Coast ports. Today, it's reversed. It's 40 and 60. Most of what came into LA, Long Beach, got on some kind of land bridge, rail to Chicago, rail to Dallas, and moved off. Well, obviously a large population there to keep that, but there wasn't a lot of export business there other than sort of bulk goods, agriculture, things like that. So when the Panama Canal widening occurred, the bigger post-Panamax ships could go, it allowed for ships to transit the canal and go to the Gulf and the East Coast ports. And that was a good thing because ships that came into LA largely left empty. So they were sort of deadheading out. Ships that where the import-export ratio is kind of 1-to-1, which describes virtually all the East and Gulf Coast ports, were able to refill and then head back out again. So there was an economic reason for that, but it wasn't really available until that widening of the Panama Canal and in response to larger ships that were being constructed by the shipping companies. The last two things were really interesting. One was just this kind of disconnect that occurred between consumer sentiment and consumer spending. You had this kind of crushed consumer spending or consumer sentiment going on during the pandemic, but everybody was spending. And even today, sentiment might be down, but the spending has increased every year. So that's a phenomenon that occurred. And then just kind of an immediate focus by anybody that has to ship goods to outsourcing strategies. And the need to create supply chain resiliency, diversify product sourcing, and that ultimately, in turn, triggered this absolute renewed focus on reshoring, nearshoring, and onshoring manufacturing, which is a story that you hear about a little bit, but it's happening in real time and is driving. So all of these things are driving a tremendous amount of demand for industrial logistics real estate. By the end of 2020, e-commerce as a percentage of sales, to just underscore that growth, went from about 17 or 18% to almost 22.8%. That was about 10 years worth of growth inside of 1 year. It was incredible. It dropped off slightly from 2020 to 2022, but then by Q4 2023, I hit a record of 23% of on-auto retail sales. That highlighted how durable, persistent e-commerce has become. And then today, the 10-year projection shows that number reaching 35% of total retail sales in 2035. And the space demand associated with that growth is significant. But that 35% is also significant because that's not the expected inflection point of when we might, or e-commerce as a percentage of retail sales just tops out. That's just a projection of where it's going. So I think that's also interesting. We don't know what that inflection point is today. That will dictate a lot of when we see things cycling down. A couple more things. Ultimately, COVID dramatically drove everybody to demand same day and ultra fast delivery. Think 2 hours. And then just an unrelenting rise in transportation costs and kind of a strained labor availability. And that made having more small box distribution centers located within and proximate to population centers essential to occupier supply chains. And then two more points in terms of this sort of evolution. The first is e-commerce returns, or so-called reverse logistics. We could spend an hour on this topic, and we have spent a lot of time thinking about this. Generated a white paper back in 2015, 9 years ago, thinking that things would really evolve fast as related to reverse logistics. But it hasn't. It's starting to again, and I think it's going to take off, and I'll talk about why. But suffice it to say, about 30% of all goods delivered via e-commerce online to your house get returned. That is a huge issue for retailers. Very slow to set up adequate capacity, process those returns, and have lost billions of dollars as many of these return items are thrown out for the most part, or some are resold for pennies on the dollar. These are not high margin businesses to begin with. So you'd say, well, why in the world could that happen? We used to say, because nobody at any one of these places, Walmart, Target, wants to be the president of lost sales. And because the forward supply chain has been so kinetic for so many years that it's virtually impossible to send things back to the distribution center in which they came out of. You could go into a distribution center today and find a corner in that warehouse where there are just boxes laying, not in piles, not neatly stacked, but just laying all over the place. They're just waiting have enough of them to take them out to the dumpster and throw them out. And that's a remarkable thing. But the space demand, if all retailers set up dedicated return centers, would equal hundreds of millions of square feet overnight, most of which would reside in small box buildings where there's virtually no need for cube space, but rather just an operating system that can quickly move returns expeditiously on a horizontal plane from one end of the warehouse to the other to shipping to get it back out again as fast as possible. Nothing would be stored. It would be, and even the warehouses that do this, nothing's stored there. Everything is in and out. And this is slowly happening for the reasons we talked about, but it's still slow to happen because the forward end of the supply chain is still so robust that it's hard to step back and want to devote time to that part of the operation. But at 30% getting returned, that's not a sustainable long-term situation. And my last point would be e-commerce and overall demand for U.S. industrial and logistics space just changed investor sentiment over the years, and especially in the last 4 or 5 years, and the perspective on U.S. industrial and logistics as a real estate sub-asset class. And just to illustrate that point, and another one of my partners likes to point out that 20 years ago, if you attended a 2-day real estate conference, it might only be the last 30 minutes of the second day after lunch that was dedicated to industrial. Today, industrial is first on the agenda. Even the non-industrial investors show up for that. And even the traditional non-industrial real estate investors have actually moved into this space in some form or fashion.
Yeah, the changes are phenomenal. The vast majority of our listeners are not buying logistics or developing logistics. They're more likely to be consumers. So I'm going to try to restate what you just went through from a consumer standpoint and tell me if this sounds accurate. So I used to go to the store to buy what I wanted. Now I can go on my phone or go on my computer, go to Amazon or anything else like that, and click and order what I want, and it shows up at my door. So I don't have to leave and wait in line. I can just click and it shows up, and in many cases it's cheaper. And so you had this gradual adoption through time as people who are more tech savvy were more comfortable doing that. COVID hit, everybody gets thrown into the deep end and they learn to swim and realize, you know what, this is actually pretty efficient. And you get more and more of that. And then as that demand grows, there's, okay, what more can I get? I want to buy more things online. I want them faster. And so this demand gets pushed through to the supply side, and that business grows and has to adapt to that shift in demand. Is that roughly how it's played out? And if that's correct, what do you see as the next big inflection point? What's the next big step that this process takes?
By the way, that was perfect. So I should be interviewing you. That conciseness was perfect. That next disruptor is already embedded in the overall disruptor that is e-commerce. And that started with digitalization, and that's AI. You think about AI that generates the algorithms that allow an Amazon or other retail marketing platform to know what goods to store in a distribution center within a particular population. Amazon already does that. I've been using AI for a while, but it's getting more sophisticated in order to predict product demand to help keep inventory levels in check and avoid over or under purchasing for their warehouses. One of my other partners who lives in downtown Chicago tells a great story from a year or so ago when he placed an online order for eggs, Zyrtec, having allergy issues, and a dog chew toy. Within 45 minutes of placing his order, a delivery guy was at his door with one bag and 3 items. And he just said, "You can't be here with my 3 items." And the guy gives him a fist bump and walks away. And you think about that, you obviously need a single distribution center close by that has refrigeration, a pharmaceutical section, and a pet section. That is a poster child for AI. And that is where that has evolved to. And it's evolving even further. Those algorithms are getting more sophisticated, and it's tracking what that local population needs, wants, and orders 24/7.
So really quick on that, are you saying that the technology can get to the point, or maybe it's already there, where in some ways it can predict what you're going to want before you do?
Well, I think if you go on to order something tomorrow, and everything you've ever ordered seems to show up somewhere on that screen, that's just tracking. And then it's suggesting other things that it thinks you might like. And if you look at those things, you might say, well, yeah, I kind of like those things. Those things are interesting to me. It was funny. I was probably one of those guys going into COVID that I never ordered. I had my adult children move back for a period of time from Chicago and New York, and just wanted to be in a safe environment with COVID. And nothing that came through that door in those first 6 months was ever for me. I just walk out to the porch and pick things up and bring them in and put them down. I didn't have to look at the box. It didn't matter. I knew it wasn't for me. And then one day I needed some new sneakers And my daughter said, let me show you how to do this, Dad. So we went, I ordered a new pair of sneakers. They were there in 2 days. They were perfect. And I have been an absolute convert since. But I always thought it was interesting because I figured e-commerce wasn't for me. It was just for my family. To move on from that point, if you think about where AI has taken us through automation, these are intelligent systems that can navigate through warehouse aisles. They can locate specific items, can swiftly perform tasks like picking and sorting and packing. And you've seen incorporation of AI-powered robotics into warehouse workflows, and they expedite and improve productivity. They're better for safety, and it can minimize human error. So there are a handful of very large, fully automated warehouses out there. These things, if you were to go into them, they're operating in the dark. It might be 1,000,000 square feet, and it's just these machines moving all over the place. There, they use those automated logistics solutions to carry out all the operations from goods receiving to the processing of orders and then dispatching them. Again, they operate basically in the dark and are characterized by minimal operator intervention in all their logistics processes. There are a few people there monitoring all this stuff. Interesting why those automatic retrieval systems, which are very sophisticated, have evolved to work in virtually any size space. And then they can even work in the back of a retail unit in a retail center where maybe you're doing some micro distribution out of. But the fully automated small box platform hasn't really happened. And I'm sure it'll evolve over time, but it's not there yet. And that's probably because think about the outbound goods are going out not in any consistent sized box, but going in absolutely a multitude of different size boxes, which then need to get onto a van. And that van load needs to be done and packed in a certain way that is sequential and also one that is easily managed by the driver and allows for some semblance of efficiency and motion to get through the run at a time. So for now, I think that's better managed by humans, but certainly these things are evolving.
And I guess if you just continue along that path, it's all about getting things faster. And that's, I guess, the attraction to small boxes is you can fit the small boxes in that last mile closer to the neighborhoods that are going to demand these products arrive to them faster. And I guess that's like the next phase in this growth in logistics. Does that sound right?
Yeah, the final mile phase has been the last piece of that evolution. And again, I'm sure there'll be other things. I mean, you can look, again, I mentioned micro distribution, the concept of using retail centers to have some things available to look at and go try on. Look, there's still always going to be, I believe, the desire for a consumer experience and to go in, see a number of things on display because you might be looking for something in particular, but maybe you see something else that catches your eye. And I think human natures, will drive us continually to some level to stores to look at things. But those stores are almost perfect locations for returns and for pickup and things like that. Not necessarily being delivered, but also for you to go get an experience and either pick up and deliver things you want to return or you want to take with you. So the small box end of this really is important historically. And this is why those absorption ratios are so different. 1 to 1 to 1 on small box and 1.3 to 1 for big box. And that's because when markets improved in their recovery phases and heading to peak, all industrial bulk assets were built somewhere out on the market periphery, outside the beltways, out in some cornfield somewhere, where land was cheaper, where there might have been some tax abatements and things like that, and where it was obviously not scarce. And there wasn't really a need because you could take your time getting that to somebody. Nobody was looking for it. You ordered something, got there a week or two later, you're like, great, I finally got my X. That's changed. And so now you're trying to fit into these sites that are infill, trying to find the smaller assets. But by the way, 16 billion square feet of inventory across all markets in the US, roughly 60% of that is under 200,000 square feet. That was always the vast majority of what was built. I mean, that was the basis of industrial or logistics real estate for years and years. The big box stuff was the big nuance change where we started putting things into these million, 2 square foot buildings. So largely the new buildings are all big buildings. And that's been the last 15 to 20 years. For new builds, that's largely what was being built. Today, in our strategy, we're looking to build the small buildings and the small boxes, in addition to buying existing boxes, and either they work or we're doing some sort of extensive renovation to those boxes to improve their functionality or be able to install some technology that makes them work better. So I think as we think about maybe as a context, I would say that our investment strategy has been consistently focused on and exclusively focused on small box assets for the last 15 years. And again, just to note, our average building size over 22 years for an existing box that we buy is about 125,000 square feet. For the buildings that we build, it's about 180,000 square feet. So we're staying small, even on the new delivery side. I mentioned this, but the starting point for our strategy really started with data that continues to support the investment strategy that we're in today. And the top line is that historical vacancy and absorption highlights that there's less volatility in small box assets versus big box. And specifically, we've been tracking data monthly on a 10-year rolling basis since 2011. And the average annual vacancy rate for small box assets from 50 to 300,000 square feet is 150 basis points lower than for big box assets over 300,000 square feet. And the supply-demand ratio, which I mentioned a moment ago, is 1-to-1 for small box and 1.3-to-1 for big box. The vacancy gap today is between 300 and 550 basis points, and I'll touch on that in just a second. So the benefit of exclusively investing and operating in the small box asset market, we think, is reflected in our overall rent growth across our Core Plus Fund series, which is today consists of Fund 6 and 7. We just launched Fund 8. But we saw an average rent growth over the last 5 years of 38.5% annually. And that includes rent growth of 38.8% in 2023. And rent growth in Q4 of 2024 has been 37.7%. So it hasn't diminished over that time. And I think just, again, reflects the high cost of and scarcity of infill land in our targeted markets, where there's just consistently less new construction, again, historically lower net absorption ratios, and then yields, which are historically higher in the sort of less efficient, smaller building marketplace. The value is also enhanced for two other reasons. And one, because individual small box assets are just generally under pursued by the larger institutional investors for reasons we talked about earlier. It's just deal size. And then two, on the flip side, they want access to these portfolios of small box assets and now aggressively pursue them with their larger funds. And it puts them into all ends of the continuum between sort of first mile to last mile. But they can't and won't go focus on one-off. One of my friends in the industry was with a very large group, and they actually hired a handful of people to go do small box investing. So we did it for about 4 months, and we said, we can't, with too much money to place. This doesn't work. So that was the second piece of that. But if you kind of look at the fundamentals, and this goes hand in hand with sort of where our rent growth has been, we're seeing generational fundamentals remain and strongly favor sort of small box over big box. Obviously, we like the end of the market that we're in, but that's highlighting a bifurcation that's really occurred in the last few years between big and small, and then the bifurcation that we've been working to leverage for the last 15 years in our investment strategy, but now on a much more significant scale than what we've seen over that time. This isn't forever, and I'll touch on that. But from our perspective, again, that's entirely consistent with the historic performance of small box properties, and it shows up in the current vacancy rates. Coming out of 2022, we were at 2.9% vacant across 59 markets tracked in the U.S. So we like to use CBRE's statistics. Coming out of 2023, we were at 4.8% vacant for those same 59 markets. At the end of Q1 2024, we'd increased to 5.3% nationally. However, vacancy for buildings between 300 and 700,000 square feet rose from 6.6% at year-end 2023 to 7.5% at the end of Q1 2024. And vacancy for buildings over 700,000 square feet rose from 8.2% at year-end 2023 to 9.1% at the end of Q1 2024. And here I'd note that because of that increase in vacancy, we expect a slowdown in a rate of rental growth for those big boxes. Now compare that with small box, where vacancy for buildings under 150,000 square feet was 3.5% at year-end 2023, which in our view is structural. In other words, there's an awful lot of product in that grouping that would be functionally obsolete or environmentally tainted, and then remained slightly above that at 3.6% at the end of 2024. So I think that really does underscore that. And that was predictable. If you look at 2023, we had record construction deliveries of 612 million square feet. But the building size was largely over 300,000 square feet. In fact, almost 70% was over 300,000 square feet. And if you include buildings 200,000 square feet and over, it was 85% of total deliveries. So a very minimal amount of space was delivered in new construction under 200,000 square feet, and hence these vacancy rates. At the same time, and there's ultimately a good news story just for the sector overall, and I think in for larger box. While construction starts, they decelerated in 2023, and that was reflecting a combination of high interest rates, a less robust lending environment, and then just less demand from big box occupiers. While those record deliveries caused that substantial increase in vacancies, now construction's declined by 52%, probably in this year going to 60 to 70%. And that's really set the market up for a significant shortage of big box first generation space for late 2024, 2025, and going into 2026. And personally, I think the economy will be more certain by then. I think the rate environment will stabilize, and I think that'll allow the big box market to recover. And then if you look at CBRE's projections, by the end of 2025, they project that vacancy for the entire national footprint will be back right in the low fours again, which is going to sort of restart the entire upcycle for the industry. So that piece. But I think in the interim, and again, going back to this push for same day, same hour delivery by e-commerce companies, that just continues to fuel demand for our infill small box. And it's even been beneficial in new box development. It's made the lending environment, which hasn't been there for the bigger box construction, but has made debt available for smaller boxes just because there's a perception of they're less risky because they're smaller bite sizes. So we've been able to get debt. And then all of this, and the reason for rent growth remaining durable and kind of looking at it long term, not only in our small box, but ultimately in big box, is that rent as a percentage of an occupier's spend is only 3 to 6%. And that's in spite of all the incredible rent growth that we've had as an industry and even in our smaller boxes. And it's been at 3 to 6% for 5 years. It might have been 2 to 5% going back 10 years. It was always the lowest component of the spend. But that tells you how much all the other costs have accelerated, and especially transportation, which is up to 45 to 70% of an occupier's spend. So as a result, and we're seeing it in our own rent numbers, there's been almost a price inelastic environment for small box rents. And that the interesting part of that is to address rising transportation costs. The emphasis is on having even more small box distribution centers in more locations closer to population centers. So to us, we think the higher growth environment, rent growth environment will persist for the foreseeable future.
It's really interesting. If you think about the demand from the consumer side, it seems pretty clear that that's not going to go away. Once people get used to ordering online and then receiving it quickly, especially as the delivery time improves, that's something you can't reverse. So the demand seems to be there. And as you've described, there's an undersupply that hasn't been able to keep up with that demand, particularly in small boxes. Is it difficult to enter that small box space? You touched on it a little bit. And is there a material early mover advantage for those who provide those small boxes?
It's interesting. Clearly, the last couple of years have shown that if you have capital, you can enter the U.S. industrial logistics space. We've seen retail, multifamily, and even office fund managers enter the space simply because it's been so strong and is now fully accepted and highly desired asset class by institutional investors. And also the returns are just there on a comparative basis, really above any of those other asset classes. So in my view, the early mover advantage already resides with investors like High Street who have been in the space for many years. And it's interesting. I think there's a perception that industrial logistics is just less complex than, say, office, retail, or multifamily. And at some level, that's true. After all, we're investing in building boxes of various sizes. They're not particularly, don't appear to be very complex. But there are a lot of things to understand about the nature of logistics and supply chains, and really whether a given building in a given location is a better investment bet than another. And for example, you may have a very well located asset, but physically it just doesn't work that well. The clear heights, which are the distance between the floor and the underside of the truss that supports the roof, may be just too low. You can't really do much with it other than move things around horizontally. Truck turning radiuses. We're still operating in this country on a 53-foot tractor trailer transportation module. In fact, that's probably what hurt, well, a lot of other reasons that hurt a deal going into these multi-story buildings going into urban areas. But it's very difficult to get around urban streets with those 53-foot tractor trailers. Europe is on they use a much smaller truck module, which is why even in some of the Asian countries, China, Japan, multi-story industrial works very well. But in addition to that, just loading configurations, whether or not there's enough of a truck court or whether the truck court includes the street, that could make a building undesirable. The column spacing inside the building. If you're on a 20-foot module, which a lot of the old buildings were, it makes it very difficult to put modern racking systems in and using the modern machines to go pick the product off those shelves. Ingress and egress, a lot of times it's just efficient. Trailer parking today, people want places to drop trailers. That way they have empties that are available right away that they can use. So at the end of the day, technology has driven some very specific requirements for what works and what doesn't, particularly with new ground up development. And then kind of going back and just talking about clear height and why that matters. 20-foot clear heights were commonplace before the 1980s. Industrial buildings have just become taller and taller in recent years. And today, newly constructed assets and the ones that we build that are 150,000 square feet and above have clear heights of 32 feet to 36 feet. E-commerce users in particular, they are really looking to maximize the efficiency of distribution operations, and storing more product within the same building footprint is a clear win. If you take a look at a 100,000 foot warehouse, so that structure offers an internal clear height of 30 feet. The building essentially has 3 million cubic feet of space for capacity. If that property has 36 foot clear heights, then the capacity is 3.6 million cubic feet, which is 20% more. But you pay for industrial space by the square footage of the building interior floor. So a couple ways that you can really get the most out of an industrial building. Unlike an office building, you can run 3 shifts. So you can run that operation 3 times a day, 8-hour shifts to maximize the productivity coming out of that asset. So the importance of clear height and being able to operate 24/7 is virtually all new distribution centers intended for infill or last mile are built with clear heights in excess of at least 28 feet, but typically 32 to 36. And again, that allows for not only multi-level racking systems, and we could spend a lot of time on that because pallet sizes matter and sort of how far you can rack and how much you can rack, but also for sorting and picking operations, which are critical to the e-commerce last mile. So for small boxes, you just have to consider a number of factors to determine what the right clear height might be. Taller might not be better depending on the use or the user, but tall is always right. So whether it's 28, 32, or 36, all those things matter. And then finally, and I think just to talk about the early movers or people coming into our space, and I think this is just inevitable, but newcomers to the market are either forced to chase yield, maybe acquiring less than B assets or buying in tertiary markets or submarkets, or buying less desirable and even some flex space. Or if they're viewed as a credible buyer, and let's say it's somebody that's a big time multi or former office group that has deep pockets, that group might end up paying the most in a full auction bid, which might just be way too much in order to win that bid. So there's lots of reasons why I think the ship has sailed. It doesn't mean there's not room on a market that's as fragmented as ours, but I think the early mover advantage has left the train station a long time ago.
And so once you either buy and modernize these buildings or build it from the ground up, what's the exit strategy? How do you sell them? Who are typically the buyers?
As part of our risk management, I just want to put this up front. We underwrite every property we buy or every small portfolio we buy to sell as an individual asset. So we end up selling one-off assets or small portfolio of assets when we've executed the business plan for the asset and when we think we can sell it, achieve our underwritten return, and importantly, our underwritten multiple. In doing that, we avoid underwriting assets to sell as part of a large portfolio because one, that would make us an aggregator, which we are definitely not. And two, you're assuming a portfolio premium in your exit that would probably allow you or incline you to underwrite at a more aggressive exit cap, which we think is fundamentally terrible from a risk management perspective. So that said, we'll generally exit around 25% of a given portfolio one-off, really pruning it to get to the most homogeneous grouping of assets we can have, and then look to see if there's a portfolio sale opportunity where there might be a large portfolio premium available in the market at that time. And a lot of that, Alex, gets driven by debt. Today, the CMBS market just woke up at the end of last year. It was non-existent. So all those deals that got done 2-3 years ago, $2 billion type of portfolio sales, there's been no debt available to make that work. The CMBS market is back this year. I think there's been almost $7 billion done. A lot of it's been done by Blackstone, but you got to have debt. So the debt that's available in the market sort of matches up with what's you can go sell. Today, the sweet spot in the market across all lending is probably still 25 to 75 million. There are some deals getting done that are bigger. But once the lending market really begins to recover, rates settle wherever they're going to settle to, and the leverage starts to turn positive from what is largely negative today, we'll see the portfolio opportunities come back. But for the moment, we even look at our portfolios, our Fund 6 portfolio, which is 2019 vintage. We've done a lot of great work there. We've had tremendous amount of rent growth, a lot of lift in the overall, what we call reversionary yield that we look at every year, which is NOI over our initial basis, has grown substantially. But you kind of have to wait and see. Looking back on Funds 4 and Funds 5, we did sell, after selling roughly 25% of each of the assets, 25% of the assets in the portfolio one-off. We then sold the balance to Blackstone and KKR, respectively. And the premium in each was in excess of 300 basis points above our targeted net return.
One topic that we've discussed in the past is our cycles. And I know you believe in cycles. You've seen many in your career. Would you talk to us about that and why you think these cycles are destined to repeat over and over again?
I always like to say, and with probably too much age and maybe not commensurate wisdom, that I just don't believe in paradigm shifts. I do believe in cycles, as you said. And while this sector cycle has been a very long one to date, driven largely by technology, and while I believe it has more years to run, it will eventually cycle down to the less dramatic. But for now, the runway looks long, clear, and promising to me. But all of this is happening within the macro cycles that flow like waves to the shore. They're perpetual and repetitious. And while we're experiencing this elongated cycle within the U.S. industrial sector, which has survived and thrived through COVID, high rates, capital markets dislocation, the sum total of those things would still weaken considerably if we had another recession like the GFC. The difference is that technology tends to drive certain industries back to life faster than might have been imagined when the downdrafts initially started, which was entirely the case with the logistics sector. And by the way, the first mentions of a paradigm shift occurred back in 2006, 2007 in our world, when capital-driven momentum buying was aggressively pushing cap rates down and values up, but without any corresponding real estate operating fundamentals. It was just all momentum buying, and we kind of know how that worked out. So while tech could be the basis for touting a paradigm shift in our business, in my view, there's simply a cycle out there. In this case, it is an end of the hypergrowth and product development sort of sitting out there today. And I think that will largely correspond, and I mentioned this earlier, with e-commerce as a percentage of non-auto retail sales hitting its inflection point. I think that will mark the end of the cycle in logistics real estate until some other technology allows that to sort of remanifest itself in growth against as a percentage of retail sales.
You just talked about one of the key risks to this secular tailwind in logistics and e-commerce and that whole dynamic. Who do you anticipate to be the big winners and losers of this secular tailwind as long as it lasts? Retailers probably won't do well.
Yeah, logistics real estate over retail real estate, and e-commerce over pure bricks and sticks retail. And I think the loss is already there, and I don't think it improves. At the margin, I think it might get slightly better. Been a lot of work done by retailers to just inject more entertainment into their physical assets, and I think that's great. But I think it's going to be the few and further between rather than the norm. I think the super centers, outdoor retail, the high-end malls, I think they all continue to survive and do pretty well. There'll be bumps and bruises here and there depending on how well a particular retailer is doing or if an anchor suddenly has financial issues. But I think that's the biggest one. And then I think losers may also include companies that don't figure out how to master reverse logistics, because that 30% is obviously not a static number. It's on a higher and higher nominal amount. And so it just gets to be too much. And I think that would be the other group of companies that I would see as losers in this logistics realm.
This has been great, Bob. I just want to end with one question that I ask many of the guests. Is there a unique insight that you'd like to share? Obviously, your expertise is in commercial real estate, industrial logistics. Is there a unique insight that you'd like to share with our listeners in your area of expertise?
I won't even attribute it to myself, but one of my colleagues made the comment that we really do need to future-proof our buildings. And this does sort of tie back to everything we've been talking about. And as we build our next gen small box buildings, our goal is to the best we can anticipate the future needs of tenants. And so hence the term future proofing. I love that term. Providing the physical building out attributes that we think will be just as valued 10 to 20 years from now as they are today going into these new buildings. And these include, again, high cube space, allowing for greater storage of goods and distribution, leasing flexibility, having these generous truck courts for a high degree of maneuverability, trailer parking, trailer drops, and then sustainable components like cool roofs, the ability to install solar to create either community solar or solar specifically for that building, low flow fixtures, and high efficiency HVAC units, and really abundant power. Power is just important, and it's been strained by the rise of the data center and AI, which uses an extraordinary amount of power. So any building we build and construct has to have abundant power and maybe, again, power for the future beyond for systems within the building that might be AI systems that are going to need to draw more amperage. So those are the things that I think from an insight and investing, those are the things I think we need to do. End of the day, and then we also want to acquire assets in locations and with attributes that we think tenants will want for the next 20 years. And we've been doing that for the last 20.
It's very interesting what you just said, because the buildings that were constructed 20 years ago, they were forward thinking at that time, but all of that quickly became outdated. And you just want to make sure that what you're putting in the ground today is not outdated 5-10 years from now. And so you really have to look at it through that lens of what does the next 5-10-15 years look like? And a lot of that is dependent on your understanding of how the space has evolved through time, what the potential is, and really thinking ahead. It's not easy to do.
No, it's not. And we are not holding a less cloudy crystal ball than anyone else in the industry, but we all do our best to try to see through that as best we can.
Bob, this has been great. I learned a lot listening to you. I think it's an industry that we all touch as consumers, and it's really helpful to see behind the scenes how it works and potentially where it's headed. So thank you for taking the time.
Absolutely. Thank you for having me.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.